In this video, we are going to walk you through some capital market interview questions and answers. Before we start, please subscribe, like and share. In each question or section, we will give you 10 seconds to think about your answer. Feel free to comment below answers you have for those questions. Also, let us know video topics that you would like us to create. Make sure that you stay with us till the end of the video. Let's begin. Let's spare a few seconds to think about what kind of capital market interview questions you have in mind. Feel free to comment below your thoughts. Number 1. What is net present value? Net present value, or NPV, is a financial term that addresses the cash flow of a company. It's a value that represents the difference between how much cash is flowing into a company and how much cash is flowing out. Identifying this value is a good way for investors to learn about a company's operations before deciding to work with them. Number 2. Which cost is higher? Debt or equity? The cost of equity is always higher than the cost of debt for a number of reasons. One of the biggest factors to consider when focusing on debt versus equity is that the cost of borrowing with debt is tax deductible. Equity is also more expensive because equity investors don't always receive fixed payments, unlike lenders. Additionally, in the financial structure of a firm, debt receives a higher priority than equity in the case of bankruptcy or liquidation. Because of this, lenders will get paid first, so there's less risk associated with debt as well. Number 3. What does WACC stand for? WACC stands for Weighted Average Cost of Capital. This term represents the proportionally weighted calculation of a company's capital. WACC takes into account every source of income for the firm and includes factors such as tax, debt, equity, and depreciation of the firm's assets. Number 4. What is monetary policy? Monetary policy is a governmental policy that controls the supply of money to their country. Monetary policy plays a large role in the availability of money in the marketplace. The monetary policy of a government also affects the cost of money as well as the rate of interest on it when deciding what monetary policy to implement. Governments typically work toward goals of stability and growth in the economy. Number 5. Can a company make public issue of equity shares if it's not fully paid up on any of their partly paid shares? Yes. A company can make public issue of any equity shares even if their partly paid shares aren't fully consolidated, because the equity shares represent capital that wasn't included in the preference shares. An important consideration for this scenario is that the directors of the company must decide within 1 year of the share allotment whether or not they want to offer shares to existing holders of equity in proportion to debt that hasn't been paid in that holder's name at the time. Number 6. How do listed companies price their issues? Listed companies price their issues by making it free for the equity shares through public issues. A listed company will balance issues between capital and public right basis through the offer document that allows for both public and rights component compromises that are used to issue securities at different values.